7张图表解析美股七雄的一骑绝尘。大型科技股今年重新夺回了市场领头羊地位，七雄迄今已大涨 75%， 市值已膨胀到标普500指数市值的 30%。大型科技股今年重新夺回了市场领头羊地位，他们究竟领先了多少？苹果公司、微软、Alphabet、亚马逊、英伟达、特斯拉和 Meta Platforms 被统称为美股七雄。2023年，七雄股票已累计上涨 75%， 令标普500指数中其他493家成分股公司望尘莫及。这些成分股公司的涨幅仅为 12%， 而该指数整体上涨了 23%。根据高盛全球投资研究部的数据，七雄市值已膨胀到标普500指数市值的 30%， 这已接近任意7只股票组合的历史之最。Allspring Global Investments 主动型股票投资主管 Ann Melati 在谈到该巨大表现差异时说：“对我来说，在想到一个应该代表如此广泛的公司群体的指数时，这个数字令人震惊。”这些大型科技股在全球的影响力也不容小觑。在声称覆盖了全球约 85% 可投资股票市场的基准指数 MSCI 名胜所有国家全球指数中，七雄的总权重现已超过日本、法国、中国和英国所有股票的权重总和。长期以来，投资者和策略师一直对市场集中度表示担忧。当市场的大部分涨幅都是由少数股票带来时，就更有可能在少数重量级股票下跌时下滑。去年，随着美国联邦储备委员会开始加息，大型科技股暴跌，这些担忧显示出了先见之明。当利率接近0时，投资者追逐科技股和其他成长股带来的强劲回报，但当利率开始上升时，这些股票突然面临风险较低的投资的竞争。2022年，七雄股下跌了 40%， 总市值损失了 4.7万亿美元，而同期标准普尔500指数中的其他成分股下跌了 12%。大多数投资者预计2023年将大同小异，然而大型科技股却开始了疯狂的反弹，克服了银行业危机、对政府债务违约的担忧以及中东和欧洲战争的影响。大涨背后的原因何在？人工智能 AI 的炒作在华尔街掀起了一场风暴，增强了人们对这些公司未来将产生暴利的希望。此外，经济数据强劲，加上通胀缓解，推动了对利率见顶的压注，为科技股提供了新的动力。2023年，微软股价飙升 55%， 11月股价创下历史新高。苹果公司上涨 52%， 并于6月份成为首家估值突破3万亿美元的美国公司。英伟达股价上涨2倍多，市值突破1万亿美元。很少有其他股票能跟上这样的上涨步伐。据道琼斯市场数据，尽管标普500指数距离2022年1月创下的纪录仅相差 1.6%， 但该指数中只有 23% 的股票距离纪录高点在 10% 以内，这低于 28% 的历史平均水平。市场的盈利增长也应归功于七雄。今年，标普500指数公司的盈利量将增长 0.7%。FactSet 的数据显示，如果没有七雄的贡献，盈利可能下降 4%。一些分析师表示，他们预计科技股的主导地位不会延续到明年。他们认为工业、材料和运输等遭沉重抛压的类股将跑赢。Raymond James Investment Management 首席市场策略师 Matt Orton 建议投资者增持精选小盘股和新兴市场股票。他预测这些股票将受益于美元走低和利率下降。Orton 说，未来你们很可能不会经历我们已经历的过山车般的情绪。我们已进入一个正常化程度略高的市场环境，在这个环境中，一些长期不起作用的东西终于又开始起作用了。一些大型科技股仍未从去年遭受的打击中恢复过来。亚马逊、Alphabet、Meta 和特斯拉现在的股价还低于2021年底的价位。投资者也显得谨慎。路福特里博的数据显示，尽管截至今年11月，他们向以科技为重点的股票共同基金和交易所交易基金 ETF 净增投资了41亿美元，但这只是2022年同期约79亿美元净增投资额的一半左右。Angelus Investment Advisors 的首席投资官 Michael Rosen 说， 科技股重新飙升的一个原因是，利率上升帮助这些公司几十年来首次获得了现金收益，这增强了这些公司的资产负债表，帮助他们实现了更高的利润。Rosen 说，利率根本没有利润重要，利润是在哪里产生，因为那才是我想拥有的。与整体市场相比，科技股的估值仍然显得昂贵。以未来12个月的预期利润计算，英伟达的市盈率为25倍，微软的市盈率为31倍，苹果公司为30倍。相比之下，标普500指数的市盈率为19倍。Laffer Tangler Investments 的首席执行官兼首席投资官 Nancy Tangler 说，以高估值买入科技股是物有所值的，因为在利率较高的时期，科技股能够会跑赢市场。每个人都会提到估值，但他们的估值这么高了， Tangler 说，但他们的估值并不高。在经济放缓的环境下，你希望投资于可靠的成长型企业，这些就是能带来实实在在的增长的公司。
It's the Magnificent Seven's market. The other stocks are just living in it. Big tech stocks have jumped 75% in 2023, and now make up about 30% of the S&P 500. Big tech stocks reclaimed their position as the market's leaders this year. Just how far ahead of the pack have they run? Collectively, the stocks known as the Magnificent Seven, Apple, Microsoft, Alphabet, Amazon.com, Nvidia 1.12% increase, green up pointing triangle, Tesla and Meta platforms, have jumped 75% in 2023, leaving the other 493 companies in the S&P 500 in their dust. Those have risen a more modest 12%, while the index as a whole is up 23%. The Magnificent Seven stocks have swelled to represent about 30% of the S&P 500's market value, according to Goldman Sachs Global Investment Research. That is approaching the highest ever share for any 7 stocks. It's a mind-blowing number to me when I think about an index that's supposed to represent such a broad group of companies, said Ann Maletti, head of active equity at Allspring Global Investments, of the wide outperformance gap. The influence of the big tech stocks is massive on a global scale, too. Within the MSCI All-Country World Index, a benchmark that claims to cover about 85% of the global investable equity market, the combined weighting of the Magnificent Seven is larger than that of all of the stocks from Japan, France, China and the UK. Investors and strategists have long raised concerns about market concentration. When just a handful of stocks are responsible for most of the market's gains, it becomes more vulnerable to a downturn if a few heavyweights fall. Those worries appeared prescient last year when big tech stocks tumbled as the Federal Reserve began raising interest rates. When rates were near zero, investors chased the robust returns offered by tech and other growth stocks, but when rates started rising, those shares suddenly faced competition from less risky investments. The Magnificent Seven finished 2022 down 40%, losing $4.7 trillion in combined market value, whereas the remaining stocks in the S&P 500 dropped 12%. Most investors expected more of the same in 2023. Instead, big tech embarked on a furious rally that overcame a banking sector crisis, worries about a government debt default and wars in the Middle East and Europe. Behind the blockbuster gains, artificial intelligence hype took Wall Street by storm, bolstering hopes that these companies would generate windfall profits in the future. Plus, strong economic data, coupled with easing inflation, powered bets that interest rates have peaked, providing tech stocks another boost. Microsoft has rallied 55% in 2023, with shares setting record highs in November. Apple has added 52% and in June became the first U.S. company whose valuation eclipsed $3 trillion. Nvidia shares have more than tripled, pushing its market value above $1 trillion. Few other stocks have kept pace. Although the S&P 500 is just 1.6% from its January 2022 record, only 23% of the stocks in the index are within 10% of their record highs, according to Dow Jones market data. That is below the historical average of 28%. The Magnificent Seven deserve credit for the market's earnings growth as well. Earnings among companies in the S&P 500 are expected to tick up 0.7% this year. Without their contribution, earnings would be on track to fall 4%, according to FactSet. Some analysts say they don't expect tech stocks' dominance to extend into next year, betting instead that beaten-down sectors such as industrials, materials, and transportation will outperform. Matt Orton, chief market strategist at Raymond James Investment Management, recommends that investors boost their positions in selective small caps and emerging markets, which he predicts could benefit from a falling dollar and lower interest rates. You probably, hopefully, will not have the same sort of roller coaster of emotions that we have had, going forward, Orton said. We have moved to a little bit of a more normalized market environment where some of the stuff that hasn't worked for a long time finally starts to work again. Some of the big tech stocks still haven't recovered from last year's beating. Amazon, Alphabet, Meta, and Tesla are trading below the levels where they ended 2021. Investors appear cautious as well. Although they added a net $4.1 billion to tech-focused equity mutual and exchange-traded funds through November this year, that was about half of the about $7.9 billion that they pulled through the same period in 2022, Refinitiv Lipper data show. Michael Rosent, chief investment officer at Angelus Investment Advisors, said one reason that tech stocks have come roaring back is that higher interest rates have helped them earn yields on cash for the first time in decades. That has strengthened their balance sheets and helped them churn higher profits. Interest rates just don't matter as much as profits matter, Rosen said. Where are the profits being generated? Because that's what I want to own. Tech stocks still look expensive compared with the broader market. Nvidia is trading at 25 times its projected earnings over the next 12 months, while Microsoft's multiple is 31 and Apple's is 30. In comparison, the S&P 500 trades at 19 times future earnings. Nancy Tengler, Chief Executive Officer and Chief Investment Officer at Laffer Tengler Investments, said it is worth paying up for tech stocks because they can outperform during periods of higher interest rates. Everybody comes back to valuations, oh, but they're so expensive, Tengler said. But they're not. In a slowing economic environment, you want to be invested in reliable growers. These are the kind of companies that deliver.